Hello again, everyone. I'm Paulo Speaks, CBDO and Cryptic, and today we're diving into relationship status of our industry, which is DeFi and RWAs. Constantly negotiating boundaries, committed, complicated, somewhere between code and courts. The real financial architecture is emerging right now, and to be able to explore that, I'm joined by four bright-minded people here. We have Sonia Shaw, CEO of One Asset, Andrey Fedorov, CEO of STON.fi, Jackie Kohn, head of Hong Kong and Ava Labs, and Dizian Law, Director of Business Development of Polygon Labs. Everyone is working at their section of financial infrastructure and institutional adoption. And these guys building the rails where real capital meets theory and vice versa. So let's get started. The first question that I have for you for today is, DeFi thrives on permissionless composability, and RWAs are like KYC, jurisdiction, free forms and triplicates. Where the real compromise is happening at the settlement layer, token standards, or application layer? Sonia, let's start with you. What are you thinking?
It's a bit technical, but let me answer that from a business perspective. I actually had a discussion with my CTO the other day. He's a pure DeFi guy. He used to build multiple DEX protocols, and then he even mentioned, he said, I can definitely see from the technical perspective, we are sort of adopting from pure permissionless to permissioned, and it has to be somehow a hybrid style. And when it comes to real world assets, I think this hybrid style is much needed to get compliance and regulators comfortable to fulfill that consumer protection. And then, of course, that's all necessary to push the industry, go mainstream. Without those protections and everything, we can never say we're mainstream. So I think it sits between how we actually govern the onboarding process of users, and then, of course, allow users to be as DeFi as possible once they're on chain for settlements and then secondary markets. But it has to be a gated onboarding process to make sure that it's the information and everything is in the lawful way. So I think RWA is a great push for finally accepting permission as well. From the argument, everything has to be absolutely permissionless in the crypto industry.
I do agree, it's kind of balanced, and you never know how actually you can combine these two monsters that are living in a completely different environment. Though I think that the real compromise is already looking through all three standards, and token standard, and application layer, and settlement layer. At Ava Labs, we have subnets where you can spin up with bespoke rules, custom chain, for example, only regulated in Hong Kong, but you still have an infrastructure there. Am I right, Jackie?
Yes, the beauty of Avalanche is that we're a multi-network system, so not only you can just deploy on our Ethereum-compatible blockchain. It's a public permissionless blockchain called C-Chain to access massive liquidity. We're the only blockchain system that allows enterprise institutions to build their own customizable L1s or subnets, but it doesn't mean that it's isolated. So we have this really, really amazing bridge that allows L1s and C chains between L1s to communicate with each other and move assets without silo.
I think it's very effectively gated communities, but still liquidity a little bit fenced in, as from my understanding. You can argue with that. And I think in Polygon we also have it on token standard. There was a rise of permission tokens. It's less like digital cash and more like corporate access badge. You still have wide access, but there is not fully transferable, only available for whitelisted wallets. Please, Dizian, am I right or I'm wrong?
yes, to an extent, the tokens are programmable. So you can allow certain items to be restricted to only certain people to have access to the information. But getting back to your earlier point on compliance and DeFi yield, very hard to combine together, right? So what I see in the market these days, it's some innovations happening. While at the compliant level, we have, let's say, VARA or Hong Kong MA or a lot of different regulators. Let's say, Sonia, right? Sonia. Right? So Sonia works on real estate's RWAs. So everything needs to be under a proper structure, trust, regulation, compliant way. You have a permission token. But what if we have a permissionless side of stuff? So 1,000 tokens, Sonia tokenized it, but there is another entity in BVI or Caymans that maybe buy 10% of the tokens, wrapped it, and then make it a permissionless version. So that's one innovation that can consider. And liquidity, back to your questions, when it becomes permissionless, it'll flow more naturally.
Interesting. Okay, got it. Andrey, what is your opinion in terms of where the compromise is happening right now? No, you need to push the button.
Okay. Not sure about the compromise, but well, I'm a DeFi guy. I believe that tokens, they should be neutral, meaning that if if they're different, if they are, let's say, only whitelisted addresses can, let's say, send them or something, it'll kill composability, in my opinion, because, well, we want everyone to be able to access everything and to be able to use it everywhere and so on. So we have multiple protocols. There are, like, there are DEXs, there are liquidity pools, there are lending, borrowing protocols, and so on. So if tokens are so different that, some addresses are allowed to do something and some addresses are not, and then it comes to, the interaction between the protocols and so on, I think it'll just, everything will be broken. So speaking about that, and when we think about application level and about the settlement layer, probably it is better to do it in these layers. But actually, we were thinking about that. So we're not a blockchain; we are a DEX, right? So it means that we just need to work according to the standards that blockchain has. And in our case, actually, we were thinking that, okay, so there are new assets or new tokens launched on the Eton blockchain where we are working on. And, there were discussions that probably for some types we need to use whitelists and so on. But when we were discussing that, we realized that it would break everything. So we decided not to do that. But I think that if we have to do something like that in the future, it should be application layer and maybe settlement layer, but tokens should be really neutral and universal.
Okay, got it. So you can have a slow, maybe not slow and quick debate together with Polygon regarding that. But I got the opinion. I think that the bottom line here, unavoidable trade-offs is reduced global interoperability and slower iteration due to regular and compliance checks. But in exchange, we can get what DeFi alone couldn't do and struggled to do for a long time, institutional adoption, one of the things, and regulatory clarity too. So in other words, it's going to be less anarchist potlucks and more catered conferences, but with real assets showing up. You never know what's going to be an ideal solution, but we're all working towards the better future. Though we're talking about real yield on chain, right? Where real yield is actually coming from?
Easy for me because I'm building a platform that vertically only focus on yield-generating commercial real estate assets. Like we tokenize the building already had tenants there with 5-year contracts, which means the valuation of the building is very, very standardized, and then the cash flow is very predictable, and then the ownership rights is also very, very clear. So it's a great question because I think there are a lot of problems in the industry. It's like we don't even know where the money from. You are earning 20%, 50%, but where is it actually generating, where it's from? So it cannot pass from, who's the last one to, the pump and dump, the victim. So for real world assets, it has different asset class, and different asset class have a different targeted investors audience. And then for the mainstream asset class like T-bonds or equity, debt markets, money markets, and real estate, they all very, very mainstream. They have very global standardized valuation system, fluid secondary markets, institutional involvement is very, very big, and then all the allocators come from institution backgrounds mostly. So for commercial real estate, it's actually one of the very underrated category in that asset class, which is not accessible for most people on day-to-day, basis. It's not investable, easy, accessible on-chain, but it's a great asset class that offers stability and great rental return when you understand what you're actually buying and then how to manage that well. So I think that's the whole purpose of when I said that we focus vertically only at that, and then that give us enough room to focus on the standardization of acquisition process, valuation process, secondary market building, distribution channel building, and then we have very targeted audience investor as well in that asset class. Instead of like we tokenizing everything, but we don't really know who we're selling it to, and it's hard to build a benchmark secondary market. So I mean, we believe the future should be you open your app and then you can jump on different apps or different, connect different wallets, and you can invest anything that is investable and good yield, and then suit your investment appetite and risk profile. And then we're very determined to build that profile as, the real estate, commercial real estate sector, and then we should be the one that you jump on first.
Yeah, got it. So real yield, like RWA yield, isn't crypto yield. It's old-fashioned finance wearing a crypto hoodie, and the yield comes actually from a very boring cash flow. Sorry, but it is like rental building, interest from loans or treasury bills, and blockchain just helps to make it more transparent and distributed faster, much faster than the banks. Like, that still uses fax machines probably, but yeah. Jackie, what do you think? Do you have something to add to that?
Yeah, sure. I'm not entirely sure like whether I understand what's real yield mean from your question. So I'm gonna just put real yield into two categories. One is the yield of the on-chain, like on the blockchain. So because like normally the RWA itself, if it sits there, it becomes an AUM. Like it doesn't provide anything for the blockchain as an income or as a revenue. The real revenue on-chain has to come from blockchain native activities. For example, like staking on a secure blockchain like Polygon and Avalanche, lending where the borrowers would pay a really good interest rate, and these liquidity provisions where you'll be receiving real trading fees from the AMM. So these are real economic activities on chain. So we have to work harder to drive that actual, make that RWA circulates and in use on chain instead of just sits there and become an AUM. And also, if you're talking about the yield from the investor's point of view, I just opened a Thousand broker account today, and I saw in the in the menus of all the funds they have the China AMC money market fund, And then they also have this tokenized China AMC money market fund. So I asked them, what's the difference in terms of yield? They said it's exactly the same. Then I was like, why would I buy a tokenized money market fund that is yielding exactly the same as the underlying asset? Normally, when the RWA gets to the asset layers, normally three markets emerge. First of all is the on-chain credit markets, like collateral markets, because like RWA is the perfect collateral because it has low volatility, cash flow producing, and risk evaluable. So this is what the DeFi market is lacking. It's the real credit. And the second one is the real interest rate, real like revenue, like interest rate yield curve, because the RWA actually produce cash flow. And this is also the fundamentals of capital market, whereas traditional DeFi, the yield often comes from the investor's point of view, the yield comes from volatility and incentives. So this is what the DeFi is also lacking. And then the third would be structural products. Because like when the asset gets on chain, it's composable. DeFi can do their work to kind of create a really interesting like structural products, for example, like trenching, risk, segmentation, automatic, this portfolio rebalancing. So we've been working with a lot of these tokenization platform like Centrifuge to, for example, like the Janus Henderson one. So we don't just wrap the ETF, but we're actually bringing the credit system on chain in a native format. We're also the first one to allow lending for BlackRock Builder Fund. So this is the yield, the real yield that RWA can offer to its the real asset counterpart. And I think we've been seeing a lot of things because the Fosun have launched their FUSD, the RWA yield-bearing stablecoin on us. And the things they've been doing is that, first of all, these FUSD, through a custody, you can do a mirror trading. So the FUSD is yielding 4%, but through the mirror trading on a centralized exchange, it can give you like 7% or 8%. So it's better than the counterpart. And also, there's some DeFi looping opportunities on-chain. So this is what we've also been working on as well to add an extra bit of yield when it compares to the traditional assets. Yeah.
Well, I'm glad that you corrected me in terms of the yield, because there is a DeFi yield, there is the RWA yield. DeFi yield says trust the tokenomics you can earn from staking, lending, IMMs, and RWA says trust the guy who legally obligated to pay or he gets sued. And that historically worked pretty well. Though what we should do so yield can be natively defensible on chain. DZN?
Okay, I'll try. So I agree with what Jackie mentioned just now. Essentially, I will put it in two buckets for your DeFi side of yield. At the same time, we can wrap it back to the RWA real-world yield on the DeFi looping side, right? So first on the DeFi yield, just two things, or maybe three. First would be staking. Everyone knows staking. But more importantly, where does yield come from would be from borrowing and funding. So borrowing would be, let's say I have BTC, but I do not want to sell. I'm willing to pay 3% borrowing costs to someone who supplies USDC for me to borrow. So that essentially it's one loop, borrowing type of yield, and it happens on DeFi. Yeah? And the second type would be funding, DEXs. So long, short strategies, more buyers, not enough sellers. Then you have an imbalance where perps or DEXs make their money. Funding rates. So that's where the funding yields come from. So combining borrowing, lending, and if let's say we have RWA, money market funds, or private credit RWA funds with, say, 8%. And we know the borrowing rates are 4%. This is what Jackie mentioned just now. We do the DeFi looping, and everyone works from compliant RWA, real estate yield. If we get 8%, good. put it into DeFi, and then we'll do some perp trading for funding yield, and we can do some DeFi borrowing and lending. Make the Morphos, Aves of the world, and the vault curators very, very happy.
Thank you for explanation. And Andrey, would you love to add to that from a DeFi perspective?
Well, I agree with everything, but to add, so the most obvious advantage of like having RWAs is actually access. I think so, because there are lots of people who can't access traditional, let's say, stocks or something, or because of the like high entry ticket, or because of regional sanctions sometimes and all that stuff, and so on. But access is very obvious. But then when we think about when they have it, let's say they got access to these assets. And it could be different for institutions and retail users, but I think that they want to do something with that. Okay, so I bought this, now I want to do something with that. And there are multiple DeFi products, again, DEXs, liquidity pools, lending, staking, vaults, and so on. And then they want to do something with that, right? They want to put it there. So I believe that, okay, so we have these two parts of these yields. So the like off-chain traditional yield, well, okay, it is incorporated in the asset. But then they want to get some extra, and I think that's the source where it can come from.
Can I add something on that?
No, of course you can.
Thank you. I appreciate that. Actually, I think in terms of the DeFi world, what we really need is the RWA yield to support, because there's a serious problem in the DeFi world. Everything is highly correlated. And when one thing crash, depact or lose leverage, and then everything start collapsing. So that's exactly what happened in the October 11th or 11 October. So and then they crashed the whole market, and then the whole market facing the same systematic risk, and one thing triggers another one. When the fundamental collateral is supported by real-world yield assets, that will not bring the fundamental destruction of the whole looping. That's why I think at this point of the industry development, it's really much needed to have something really fundamentally supporting that, and then not highly correlated to make sure that we grow bigger in the industry.
Yeah, that's a very valid point. Though, how we can coordinate yield so it's defensible on chain? How we can prove that's yield coming from where it's actually coming? Is it transparency? Is it price risking? What is it exactly? If you, guys, if you have something to say, you can just say, hey, Paul, I'm ready.
I think that's where the regulatory kicks in. When it comes to ownership, yield generating, transparency, reporting, this is all governed by regulatory frameworks. And then that's why most of the jurisdictions heavily focus on which government body and how they regulate that parts to make sure this on-chain is just a token, but is that what that token actually represents? As an investor, it's very hard to know without the regulatory backup.
Mm-hmm. Mm-hmm. Jackie?
Yeah, I think in terms of the technology itself, we just need a really transparent on-chain verifiable data source to tell for example the proof of reserve, proof of liabilities of these assets, and whether it's feasible on-chain in a decentralized way, and also the second one is risk. Whether the duration, whether this real credit can be verified, and also I think I actually agree with the enforcement, the legal, because looping back to the first question that you have, I haven't get a chance to answer the first question in terms of the compliance. I think the Hong Kong government has made it very clear that they don't want the Hong Kong stock the settlement itself to leave the Hong Kong stock markets, whereas the US are not that specific about that. So you have X stocks on all these, but it's actually, if you really look into the registries, if you hold this X stock, Tesla stock, your name is not on it. It's actually the X stocks on it, but the NARI, our ecosystem partners, is the only 100% compliance tokenization platform when it comes to US stock. It has the license. How do they do that? If you hold the D shares that they issue, you're not only entitled to the yield, but also you're entitled to the dividend and also the voting right. And they get the liquidity because they are deployed on multi-chain, like Solana, Arbitrum, you can get that. But the settlement itself, it's happening in a Avalanche L1s that we customize for them. That follows all the rules that DTCC requires. Only DTCC approved institutions like VanEck, Gemini can join the network as validator. So that's why not only they can settle it and with the compliance rules, but also they get to multi-chain to kind of take their asset to a broader DeFi world. That's how I think, why the legal enforcement is so important. Technically, we can do everything, right? But the legal, if the government doesn't allow you do things in a certain way, you have to find a really flexible infrastructure to kind of support the needs from the government. Yeah.
I do agree on all the points. So basically, for RWA yield to be natively defensible, transparency should be brutal. Leaving reports, proof of reserves, and receipts that match the on-chain tokens as well. Otherwise, it's like, trust me, bro, gold is somewhere in the vault. And risk pricing also should be real. If asset is volatile, it shouldn't stay 12% all the time, like a strong law of physics. It should be relatable to all the fluctuations. And enforceability is a boss level. Like, we need to find what to do when everything goes wrong, and not like, people should have legal enforceability claim and not just Discord apology. And in real world, that means contracts, humans, people at 8 a.m., like Palif at 8 a.m. with the clipboard. So yeah, I think that all these 3 points are valid. Maybe there are some more opinions. Hey, Dijon, what do you think in terms of what we should do so yield should be defensible on chain?
My personal take, it would be one word: choice. Some people are okay to give a lot of informations, disclosures, personally, so that they get KYC'd, KYB'd with a broker or an asset manager so that they can buy certain stuff that also has a lot of disclosures. Group 1. Group 2, like most of us in DeFi, we just want a MetaMask wallet or a Brave wallet or whatever wallet, anonymous, and then we'll do our own research. Group number 2. 2 groups of people have different preferences, different likes, different needs, and different wants. So let's just give everyone some choice.
But it's not always the choice, by the way. So, although I agree that there are 2 parts and 2 groups, but sometimes, like, we have even billions, I think, of underbanked and unbanked people in the world. So they don't have this choice because they don't have access to traditional brokers because of just their location, because they are underbanked, or because of like sanctions, because that all this crazy stuff that what's going on. So like just billions, okay, I think billions of people just don't have this choice, and it's a solution for them because they can go and use it on chain. Yes, is it risky? It is. Quite often, high transparency leads to lower risks, but in this case, it could be very transparent and still very risky, just because, well, I can say everything. But let's say X stocks. We also have X stocks on the TON blockchain, and for some of them, there are no liquidity pools, but the private liquidity is used. And we can imagine a case when, let's say, you buy a Tesla stock, but then you can't sell it. Is it a risk? It is very transparent, but still very risky. So it's just like we have both, and we need to work with both parts. And yep.
Noted. I think that we covered pretty deeply that kind of a question, and I think that we have around 15 minutes, and it's probably going to be the last question. that I would love to discuss all together. Andrey, you will love that one. Are we building in fragmented world, like fragmented walled gardens, or everything is interoperable and like smooth? Yeah. Where is the weakest link here in RWAs and DeFi? Andrey, you can answer first. I think it's your type of expertise.
If your question is what we are building, well, it depends on who is we, but some people are building something, I don't know what they're building, but what we are building is that we want to, we think that this isolation of the blockchains is a real problem because you just, quite often you can't, swap tokens, let's say, across blockchains and so on. So that's the problem we are solving. That's the problem which dozens of different projects are trying to solve, the different types of bridges, cross-chain applications, and so on and so on. And I believe really it's one of the biggest issues and one of the challenges, one of the most important challenges that we have and we're trying to fix. And what was the question? So we're trying to fix that by building our product. Is that an answer?
It is an answer. Just different people build in different things, of course, but I would love to hear some more solutions, how we can move from walled gardens and how we can go to global liquidity, which is interoperable. Because right now, it's true, we're fragmenting liquidity a lot. There are subnets, there are permission chains, jurisdiction-specific pools. They're often necessary for compliance, but still, it's fragmenting liquidity. How we can avoid that? Maybe not removing any kind of rules, but maybe you have some solutions to that, all of you.
By building products again, so we will have multiple, not just we, like everyone, we will have multiple products, and in the end, I think we will solve it.
Mm-hmm. Okay, Dijan, what do you think?
The bridge between traditional finance in Web 2 and the innovations in Web 3, that's the weakest link today that we probably need to build. And I think everyone is coming together. So let's say HSBC or Ryan, they have their own private chain, right? So they do all their transactions. JP Morgan also has their private chain, but they are moving towards a private-public version. So everyone is coming together. Right? Both of us, public blockchain. We are also trying to move closer towards some certain parts of information that can be private and secure. So everyone will merge eventually. But yes, for liquidity, how do we bridge the yield from RWA, from Sonia's rental yield, REIT type RWAs? How do we bring it back to the perp dexes for funding rates, trading, and borrowing and lending? So everything works with DeFi lending. And everyone wins. So the bridge, let's build the bridge.
Mm-hmm. Jackie, do you agree with Dijan?
I totally agree because I think technology-wise, the bridge, it's pretty mature. Like our asset can interoperate with Polygon's asset very seamlessly. But let's face it, I think the world of finance is not one single market. You're dealing with different jurisdictions, right? Hong Kong has their own compliance rule, has their own regulator, they have their own preference. Japan, Singapore, you name it. I don't think we'll need more of a composable technology because it's out there. It's still improving as we speak. What we need most is interoperable compliance. I think this is what we need most. This is what we've been waiting for. And we've been dealing with a lot of government and institutions, and also we have been working on, for example, in Singapore, the Grab. So if you go to Singapore right now, you can just use Alipay to scan the Grab local merchants Grab QR code, and then you can just pay RMB, and then the local merchants receive that in Singaporean dollars. So we built an on-chain FX market for them. Several years ago, when StraightX submit this application to MAS, got immediate rejection. Why? Because it's on a public permissionless blockchain. They don't allow that because this is real world financial activities. They never allow this happening on a permissionless blockchain where a North Korean hacker can join as a validator. Never. So this is the thing that we're facing right now. So that's why we have to build an Avalanche L1 for them. Only the Singaporean pass through the Singapore KYC with a Singapore IP can join as validator. Only 3 parties, Alipay, StraightX, Grab can do transactions, and then only 1 party can deploy contract, which is StraightX. So we have to kind of compromise this to meet the regulators' requirement in a certain way. So I think this is the most bottlenecks of a more of an interoperable world that we're heading towards right now.
Completely agree with everyone here, because I think that we need 2 things. First, some kind of interoperability protocols that allow transfer compliant assets that's across chains, that's still respecting regulations. And the second thing is governance frameworks. It's emerging still, but it's not enough. And a set of standard rules where every jurisdiction can trust each other in terms of all the transactions. That's hard. It's maybe can't be done in only 1 year, but still this is the future where we need to go towards to. And Sonia, what do you think? Do you agree with this previous speakers?
Yeah, of course, definitely. I think there are 2 layers of segmentation here. One is the infrastructure level, which all this layer 1 protocols are working on, how to create the interoperabilities. But another layer is the business application layers, like how we build projects on top of them, and then they also highly segmented, and then that comes with how each jurisdictions govern their policies. And then I think that's exactly the concept when we build one asset, like how we can be vertical and then how we can scale up in different jurisdictions and focus on only one thing. So I think early stage of the industry, you will see everyone trying to experiment a lot of things. As we go more bigger, more regulated, more structured of the whole industry, you will see layer 1s will have their focus in certain part. They will have their strengths in certain part, and they will target only on certain projects and certain audience. And the same with projects. You will have a certain key selling point and key go-to-market strategy, and you build on that. And then by early stage, it's good because no one knows what's going to work, and then no one has a crystal ball to see exactly what's going to happen. And we have to try everything we think that's necessary at this point.
Okay, we have around 5 minutes right now. Thank you for the answers. And maybe some quick answers for the last question for today is, what can be the next big unlock for scale in next 12 months for the industry? Unlock for scale. So we can scale the RWAs and DeFi system. What it can be. I bet the answer is legal enforceability, but maybe something else. If I would need to name one thing, I would go straight to legal enforceability, plus removing fragmentation, so we cannot live in silos. But that's the tough question. You guys? Andrey?
Not so sure about 12 months. I don't think that we'll see anything. It'll be the same in 12 months. But yeah, again, maybe I'm too focused on the fragmentation issue, but I'm thinking about that. And I agree that there are 2 parts of that, like technological part and the governmental part, but all the compliance and so on. But I don't believe that governments will ever be that fast, to let's say, align with the technology. So technology will be always ahead. I think so, unfortunately, but still. And so I don't think that anything will change in 12 months, but I believe that this, I would say, getting rid of this fragmentation is one of the things that should be done to scale all this stuff.
Awesome. Dizian?
I focus on 3 things: RWAs, stablecoins, and payments. These 3 coming together would probably result in the biggest opportunity for the next 12 months. Imagine this. RWA issuers always have a problem. How can I get more TVL buyers? Wallets also have a problem. How can I differentiate? I have a lot of users. How can I get more yield products, yield RWAs? When these two sides come together, you have RWA yields, you have the wallets, the users, and everything will come together. And of course, the RWAs will need to back by very compliant, well-regulated underlying assets that will make everything work in DeFi world, TradFi world together.
Good answer. I completely agree. Stablecoins and payments, cross-border payments especially, that will drive scale for sure in the next 12 months, 24 months, 33 months, etc. And RWAs, of course. Jackie, anything to add to previous answers?
Not much, but let me just summarize these two gentlemen have been saying. I totally agree with that because we are starting to see, I think, the real loop of on-chain finance right now. Because on the top, you have the stable coin, just like blood, providing liquidity, payment as well, because if more and more payment rails are adopting the stable coin, perhaps like if there is 1 billion of volumes of stable coin, and I think we can foresee that 100 millions of stable coin will becomes a TVL on chain. And all these TVLs, what do? They're looking for stable yield. So the second layer would be the RWA, right? That provide a little bit of yield, like stable yield, like for example, like MMF, that provides real yield and real collateral to DeFi. So the third layer would be the DeFi that creates real circulation, real usage, composability for the RWA and the stablecoin, right? So this is the application. And then the fourth layer would be, I don't know, compliance, legal reinforcement, because like you all know how struggle Facebook was when they launched the Libra before the Genius Act. It got canceled, unfortunately, but now we have the Genius Act. PayPal is doing a stablecoin, or they're knocking all of the financial institutions' door. Everyone is joining. So that opens the door for institutional adoption, and that back to more stablecoin, more liquidity. So this is, I think, the blueprint of future finance that we're seeing right now on a high level.
Awesome. And Sonia?
Jack, you did such a great summary. I feel like I'm in a class and I'm the student taking notes. But on top of that, three gentlemen already gave such amazing answers. I think I will also pay attention how AI interacts with blockchain technology. Since the AI's, its massive adoption, it actually sort of fast-track a lot of things happening nowadays in all the industries, including, the crypto blockchain technology. So I will definitely pay a lot of attention there.
That's a good one. I haven't thought about mentioning AI in this topic because I was fully focused on DeFi, interoperability, composability, permissioning, and RWAs, but AI is a good one. Awesome. Gentlemen and lady, that was a wonderful panel. I enjoyed it. I am a student that will later on review our panel and take all the notes because I would love to learn more from each one of you, more and more again, and maybe somewhere online, maybe we'll meet each other in person later on panels. It was wonderful. Thank you so much. If you have some final words, maybe like one sentence to the audience, feel free to speak up. Maybe some advice.
Yeah, maybe one single word as to what you think about the future of RWA in 2026. Any surprises? Should we start from this end? Sonia.
Clarity.
Invisible.
Okay.
Stay safe.
Good one.
Do your own research.
Okay.
Good.
Super. That wraps up this panel. Thank you so much. A warm round of applause, please.